A guaranteed way to lose someone in a conversation is to tell him you're going to be talking about financial assets. If scientists could synthesize kryptonite for the human mind in a lab, it would look a lot like a discussion about financial assets. So imagine my struggle when I had to make an entire video about this topic, and the entire video would consist of me enumerating all the types of financial assets in the world. For this reason, I decided to take a different approach. I'll leave the boring part for the second half of this video, and I'll use the first part to tell you why you absolutely need to understand financial assets and how this knowledge can change your life. The first reason has to do with productivity and debt cycles. In my very first video on this channel, I talked about generational wealth, productivity and debt cycles. In my opinion, this is the key to everything. If you don't understand the relationship between these, a lot of things in this world will not make sense to you. While I recommend watching the first video on my channel and also Ray Dalio's video about how the economic machine works, I don't want to force you to pause this video and come back in 1 hour, so I'll just recap some of the things that are relevant for this topic. First, let's answer an important question. Why does an economy grow? Well, at the base level, an economy grows because of spending. Every time you spend money, someone else earns that money. And every time that person spends money, another person earns that money, and it keeps going and going like this. Someone's spending is always another person's income. You have millions of these interactions every day that make the economy work. An economy is in fact the sum of all its transactions. Just like a business can't grow if nobody is buying the products, an economy can't grow if nobody is spending money. But in order to spend money, you have to earn that money first. The way you earn money is through your productivity. You use your time and your skills to help other people. You provide them with something of value, like products or services, and in return, they give you money. You can then use that money by giving it to other people who provide something of value to you. This exchange of value and money keeps the economy going. Now, if we get back to our question, most sane people will say that an economy grows because of an increase in productivity. The more productive people are, the more money they earn, and the more they can spend. But here's the thing about productivity. Productivity is not volatile. It doesn't go up and down all the time. It usually increases at a steady rate, and unless there's some big disruption in society, it rarely goes down. Even when it goes down, it usually doesn't last too long. If you were to plot it on a chart, it would look a lot like this. The problem is that we all know that the real economy is not like this. The real economy has bull markets, it has bear markets, it has recessions and even depressions. The real economy has cycles, and it looks like this. So why doesn't the economy follow the productivity line, and why does it have cycles? The short answer is because of debt. When people, governments and corporations borrow money, they can spend more than their productivity would usually allow them to. This expands the economy. At the same time, they also create a moment in the future where they would have to pay back the debt. If you think about it, when you borrow money, you actually borrow it from your future self. This allows you to spend more in the present, but there will be a time, or actually multiple times in the future, when you will have to spend less. As a side note, when it's the government who borrows money, it can actually borrow it even from future generations, and it will be those future generations who will have to pay back the debt. They will not pay it through taxes, but through inflation, and they will see their purchasing power decline faster each year. But that's a topic for another video. The point is that when everyone spends less in the real economy because they have to service the debt, the economy shrinks and we go into a recession or a depression. To keep this simple, debt creates cycles in an economy, because for every up, there must be a down. Now here's the big problem that should concern you. In our current economy, the one with all these cycles, there is an asymmetry. When the economy goes up because everyone borrows money, the price of assets also goes up. Your income, which is based on your productivity, does go up, but it doesn't go up proportionally to the price of assets. You can test this yourself by comparing your income at the bottom of the 2008 financial crisis to your income in the late 2019. Most likely, your income didn't go up 4 times in that time frame. but the price of assets, in this case stocks, did go up 4 times. On the other hand, if the economy were to enter into a recession or a depression, not only would your income go down, but it could also drop to zero because you might lose your job or your business could fail. To keep a long story short, if you don't own any assets and your income is derived only from your productivity, when the economy is in an uptrend, you'll become poorer relative to the people who hold financial assets. Similarly, when the economy goes down, even though the price of assets goes down, you might not be in a position to buy those assets, because your income will also be lower, the risk of losing your job will be higher, and the need for liquid cash will also be high. The last thing on your mind would be to buy financial assets. When the economy starts to recover, financial assets are the first to go up, and you still end up poorer relative to the people who hold said assets. Basically, if you wrongfully assume that productivity is what drives the economy, and that hard work is all it takes, you're playing a rigged game where the odds are against you. With each economic cycle, you actually become poorer and poorer. When you add inflation on top of that, the wealth gap becomes even larger. This doesn't mean that you should quit what you're doing and start gambling your savings in the stock market. It simply means that you should pay attention to financial assets and economic cycles and use your savings to ride these waves up or down. This brings me to my second reason why you should understand financial assets, and it has to do with generational wealth. If you plan on leaving something to your kids or your grandkids, the worst thing you can do is to keep your wealth in cash. By the time your grandkids will get to use that cash, inflation would have destroyed its purchasing power to the point where it would be worth less than the paper it was printed on. Even keeping your wealth in a simple index fund for, let's say, 30 years would not only keep up with inflation, but it would multiply your wealth several times over. Now, imagine what kind of wealth can you build if you have a better understanding of financial assets and the flow of money, which would allow you to build a better portfolio and go beyond a simple index fund. Speaking of the flow of money, this is another reason why you have to know about financial assets. What you need to understand about money, besides the fact that in the long run it loses its purchasing power, is that money is like energy. It doesn't get destroyed, it just transforms. As mentioned earlier, smart people don't keep their money in cash. They invest it in different types of assets. These investments are not static. They change depending on the market and the economic cycles. What you need is the ability to follow the flow of money. But in order to do that, first you have to know what financial assets there are out there. Obviously, I will show you what financial assets exist in this video, and I will talk more about the flow of money in future videos. But for now, let me give you a simple example to understand this better. When the economy is healthy and we have a bull market, most investors prefer to keep their money in equities or stocks, because that's where they will get the best return on their investment. When the economy shows signs of unhealthiness, people tend to move their money from stocks to bonds, because even though bonds have a lower return than stocks, they are considered very safe instruments. If a recession starts and all the stocks are going down, bonds actually give a much better return rate. Now, the thing about bonds is that they are fixed income assets. You know exactly how much money you'll get from them. This means that the number one enemy of a bond is inflation, because inflation devalues the currency. Even though you get more money from a bond, that money could be worth less by the time you sell the bond. When people fear that inflation is inevitable, they sell their bonds and move to gold, because gold is inflation-proof. Now, gold probably won't make you rich, but it will allow you to maintain your purchasing power. It's like a quick save button for wealth. Once the market shows signs of recovery, people usually sell their gold and move back into stocks. So, to recap, one of the simplest flows of money is the following: stocks, bonds, gold, and back to stocks. Understanding even a basic flow like this and having the ability to follow the money could help you tremendously in your quest to build wealth. The fourth reason why you need to understand financial assets is pretty self-evident, but I will still mention it. It has to do with the rich versus the poor. Multiple wealthy people, from Robert Kiyosaki to Ray Dalio, often said that the main difference between the rich and the poor is that the rich understand and take advantage of assets, while the poor don't. They are right. Unless you're some high-paid sports star or a famous Hollywood actor, it's literally impossible in this world to build wealth without understanding and owning assets. It's basic logic actually. Because assets are the ones who put money in your pocket, and the opposite of an asset is a liability, which by definition takes money out of your pocket. If you don't own any assets, this means that you're literally spending your money on liabilities. You can't build wealth when your bank account is constantly being drained by the things you own. In spite of the stereotypes about mindless consumerism, what I noticed though is that most people are not actually these dumb programmable cattle who must absolutely buy the latest iPhone every 12 months, pay for 10 different subscription services, or lease a fancy car every 3 to 5 years. Most people, if you get to talk to them, would actually like to invest some of their money and get a return on their investment. But they simply don't know where to start. They are overwhelmed by the terminology and the different types of assets. They are scared because they don't understand the markets, and they think it's risky because they have lived through multiple financial crises. They don't trust the Wall Street broker types who try to shield them some mutual fund, rightfully so, but at the same time they have too much trust in their currency and their governments, and they don't think that inflation and wealth preservation is something they should be worried about. I'm not saying the barrier of entry for investing is too high, but it actually is if you think about it. It's much easier to buy liabilities when they are flashed in our faces 24/7 through advertising and they are one click away than it is to buy financial assets. If someone wants to buy a new phone, he can just go on Amazon and order it. If someone wants to buy a financial asset, he first has to find an online broker that will not rape him with fees, go through all that KYC and AML bullshit, wait a few days for approval, then spend dozens of hours trying to understand all the types of financial assets, and then spend possibly hundreds of hours deciding which specific asset or assets to invest in. So yeah, when you look at it this way, it's somewhat understandable why people usually waste their disposable income on useless stuff. Hopefully some of my future videos will uncomplicate some of these things and lower the barrier of entry for a few people. Until then, just remember that ownership of financial assets is what makes the difference between the rich and the poor. The fifth and final reason why you should understand financial assets has to do with free speech and freedom. This might come out of the left field, but trust me, it will make sense. At the constitutional level, most countries provide a form of free speech to their citizens. Some more than others, but mostly you can say what you want and you won't be thrown in jail. The thing about free speech is that it's only guaranteed in relation to your government. It is not guaranteed in relation to your place of work, for example. Not a big deal, you might say. Companies have always been in their right to fire people. That's correct. They are well within their right to fire people if their speech affects the bottom line of the company. It's a free market after all. But stop and think for a second. 50 years ago, if you said something and the company you were working for didn't like that, you probably got fired, and the next day you could be working for another company. Now think about the following things. Have companies become less powerful or more powerful in the last 50 years? Have companies become more aligned ideologically or less aligned? Have they started colluding and cooperating less or more when it comes to policing speech? Are HR departments more decentralized or more centralized with shared databases and blacklists that multiple companies can access? Has your speech become more private or more public with the advent of social media? Are the things you say temporary, or will they live on forever on the internet and always be accessible for everyone who looks? Does it really matter if the government can't put you in jail for your speech in a world where corporations have as much or even more power than the government, and they also control your livelihood? While you think about these things, try to remember that when you're selling your shares, your bonds, or your cryptocurrencies on an exchange, the person who is buying them from you doesn't even know who you are. He can't even refuse to buy them from you. When a company is paying you dividends, it can't decide not to pay you specifically. When you're trying to buy an index fund of the S&P 500, those 500 companies can't collude and say, hey, let's not sell to this guy. When you're buying a gold ETF, the custodian for that gold won't suddenly decide, hey, fuck that guy, we will not hold his gold for him. Basically, the market doesn't care about you. Hell, the market doesn't even have the capability not to serve you. Besides your initial contact with a broker, it doesn't even know you exist. On top of that, there's currently a movement called DeFi, which stands for Decentralized Finance, whose purpose is to make most financial assets tradable in a decentralized way. This removes even more power from corporations and puts it in your own hands. What I'm trying to get at is that if you manage to find a way to generate your income from financial assets, there will be few entities in this world that could hold power over you. Now that you've listened to my ramblings, sit back, grab a drink, listen to the music, and look at this boring list of financial assets. I will explain all or most of them in future videos. But for now, it's important that you know they exist.